Welcome to PreDAC, and it is your host, Barrington Miller from the Canadian Securities Exchange, Director of Issuer Engagement. And we are going to hear from Gwen Preston of Resource Maven of Gwen Preston. They are one and the same. Over to you, Gwen.
Thanks very much, Barrington, and thanks to the CSE for inviting me to this PDAC event. I'm happy to be here and to just spend a few minutes looking through what I think is the sort of macro picture in the mining landscape right now. So here we go. So I'm just talking, my talk is just called It's All Coming Together because I think it is all coming together pretty darn well for the metals markets. So what does that mean? Well, I want to take a big picture look at what is required for metals as a whole to go on into a bull market. I think it distills down to sort of 4 points. We need strong demand for metals, ideally against a weak supply for those metals. We are helped in that if we do not have a strong US dollar, or you could look at that from the other angle and say we're helped if the US dollar is weak. For gold, we need negative real interest rates. And then we need investors to want to invest in metals. So you can, I say that as investors have to feel the need to diversify or seek yield, to look elsewhere than only at the broad stock market, which is usually, if they're really interested in that, then it pulls away from commodities. And I think all of those points are being met to varying degrees. The last one is arguably the hardest one, but I think that there's reason to believe that investors are feeling the need or will increasingly be interested in commodities going forward. So let's just take a look at each of these. So the first point was that we need, there needs to be demand for metals. And this is certainly more on the base metal side of things as opposed to the precious metal side. And we are absolutely seeing it in play. I mean, base metals have been doing very well in the last little while. This is the copper spot price, which is just kicking butt and taking names, pardon my language. But like, seriously, we're above $4 a pound. And why is it happening? It's the reflation trade, right? It is stimulus, infrastructure programs, recovery, all of that is feeding into an expectation that demand for copper is going to be very strong. And guess what? Supply is not abundant. And copper is always a pretty tight market. It's a massive market, but it's always pretty tight. And if you suddenly get a surge in demand, which is likely, that is not, I shouldn't say a surge in demand. If demand strengthens in what looks like a sustainable manner, it's likely that supply will not be sufficient. And that's what the market is now seeing. And that's why copper has done so well. I mean, this is only a 6-month price chart here for copper, and we've gone from $3 to $4. That's very dramatic. There will be bumps along the road, like a copper price move like we're seeing in the last month here. Is that sustainable? No, copper will not continue to shoot to the moon. It may step back, but big picture wise, I certainly am bullish on copper because the massive stimulus that is in place and will continue to be rolled out to support global economic recovery and growth just means that we need metals. And then you layer on top of that, I would say, the green technology or green energy specific support that we are getting from many governments, and in particular in the United States, that adds to the argument for metals like copper, silver, and nickel. Okay, so strong demand against weak supply. That was my first point, and I think it's fairly well met, broadly speaking. Obviously, there's lots of details for each metal that I have glossed over there, but this is just a short talk. Second thing that we need for a metals bull market is a US dollar is not a strong US dollar. It is hard for metals, which are priced in US dollars primarily, for them to perform really well if you have a strengthening US dollar. That's just a headwind. And I think there's good reason to believe that that's not the situation that we're in. I'm not saying that the US dollar is about to fall off a cliff, but I think that the broad US bull market that we've been in for 10 years now is ending, because of all of the expectations of inflation, from growth, from printing, from both of them together. And then the sort of more background, but very real things that are also happening, like China working to reduce its reliance on the US dollar. That's a long game that's in play. And from the immense debt loads that are burdening the US government and US corporations almost across the board. So I do think that we are not going to get a huge headwind pushing back against a metals bull market from the US dollar. So that's helpful. On the gold side, I don't believe in supply demand being a particular driver for gold. The driver for gold instead is real interest rates. And negative real interest rates are the most important bull force for gold, or driver for gold out there. The chart on the bottom here shows gold on an inverted axis, and then it shows the 10-year US real yield. So that's the yield on the 10-year treasury corrected for inflation expectations over the same time frame. That is what I call pretty darn close correlation, and it just is an example of the fact that real rates are the most important force for gold. And guess what? We are very much in a negative real rate environment for gold, and we are going to stay there for a while. Can you imagine a government anywhere raising interest rates right now? I don't think that that's going to happen. So real rates, so interest rates are zero. Any expectation or any real inflation therefore pulls rates into negative territory. Right in this exact moment that we're in, we have this interesting thing happening where there's a lot of uncertainty about when exactly inflation will manifest. And because of that uncertainty about when inflation is going to rear up, it turns out that the market is paying more attention to nominal rates. So what the 10-year treasury is actually yielding, and they're not trying to account for inflation right at the moment. This is what's happening right now. This is why gold is perhaps a little weak right in this exact moment. And it's because those, like the 10-year yield is up at 1.4% right now, after having dropped as low as about 0.5 6 or 8 months ago. So that's happening right now. Big picture wise, that won't remain the driver. Real or nominal yields will not continue to push the gold price around in the big picture. There just is understandably a lot of debate about when inflation is really going to manifest. Once we get a little bit more clarity on that, and it may take quite a few months to get some clarity on when inflation manifests, then real yields will once again dominate. They will reassert, and I think gold will kick off a really strong run at that point. But for the moment, we're in a little bit of a sideways situation while that inflation question gets answered. Big picture wise, though, we are in a negative real rate environment, and that is really important. I'll get back to the short term in a moment. But before I, for the short term for gold and silver in a moment, before I do, let me address the fourth point or the fourth need that I outlined at the beginning for a metals bull market. And that was a need for investors to diversify. So not just stay in S&P indexes, which is what they generally are. They're going to need to, for a metals bull market to really go, investors need to be interested in commodities. And so is that going to happen? Well, my big picture look at it goes like this. The huge pools of low risk capital that used to own bonds for yield. For many years, that's what low risk capital owned. They owned bonds for yield. They can't do that anymore. That game doesn't exist. I mean, real rates are negative. I just said that. And so that game just doesn't exist. Big pools of capital don't make money owning bond for yield. Instead, they have to play stocks because stocks just keep rising, and they own bonds for price. I mean, last year, bonds, the 10-year returned 20%, which is a crazy thing. But I just said that that's a crazy thing. And it's anytime something is crazy, that means that it has risk, right? And so these huge pools of capital are low risk. They're defined as being low risk. So they have to hedge their exposure to the stock market which they are required to play since the great financial crisis started elevating financial prices, started inflating financial asset prices so significantly. They've had to own stocks because that's the game, and they've had to own bonds for price. That's another game. But they also have to find ways to hedge their exposure to those things because those things have elements of crazy to them. And so, and these are just some examples of the risks there. How long can reflexivity last? So how long can prices just keep rising because they're rising and valuations not be the driver? Well, I think they can go for a while yet, because that's the game. That's what the financial asset inflation that we saw following the great financial crisis is absolutely in play again in the recovery from the pandemic crisis. But it will probably end at some point. Similarly, the debt side of things, the playing bonds for price, is that already ending? It might be. I just said that the yield on the 10-year has been rising for the last few weeks. It hit 1.4%. That means prices are going down. So that means playing bonds for price that's a game that's a little bit at risk right now. And does that make sense? Yeah, it does, because the Biden administration is pushing very hard to add 1.4 trillion in stimulus over the next, that package might pass in the next week. And then it sounds like they're also considering several trillion in infrastructure stimulus. Those are decisions. Those make sense, from a lot of viewpoints as they work to pull America out of the COVID crisis. But it's a lot of debt in a world that has already got a lot of debt. And so there's an abundance of supply against arguably a lack of demand. Anyways, the big picture here is simply that lots of money that has to play stocks and has to play bonds for price also has to diversify, has to hedge the risks that are very real in both the stock and bond markets right now. And one answer there is commodities. Miners currently stand out across the world of stocks for their balance sheet strength, for their free cash flows, and for their dividend yields. That's gold miners, that's silver miners, that's copper miners. It works. That's nickel miners. It works. They are almost unique. And I'm a gramophile, so I do not use the word unique lightly, but they are almost unique. I shouldn't put a modifier on that word. Anyways, sorry to diverge into the English language there for a moment. Miners truly stand out for having net cash. The rest of the equity world almost is drowning in debt. Miners are banking money, like truly, they're making so much money. And because of that, they have paid down their debts, and they are in net cash positions. That stands out for somebody who's looking to diversify against risk or to hedge risk. Their free cash flow models look really good for the next little while, and they're handing out money. They're making money so well. So they're making so much money that they're handing it out, and they've even a lot of the major miners out there, Newmont, Barrick, Freeport, so that's gold, copper to generalize. They've even fixed those dividend programs to free cash flows. And so, just the other day, Newmont boosted its dividend yield to like 3.8%. That's against an S&P 500 average of 1.5%. So anybody out there managing those big pools of low risk capital, they are going to have to pay attention to mining companies in the next little while. If they believe in the reflation trade, then they'll believe that base metal prices are well supported going forward. If they're worried about debt issuances, then they'll believe that gold prices are well supported. They don't have to believe that these things are going to the moon. They just have to believe that the current sort of pricing that we're looking at is sustainable. And if it is, then these mining companies just make a whack of money. And so they stand out as options to diversify, to hedge the risk that is inherent in the rest of the stock and bond market. So I really think that matters big picture wise. Okay, short term, I said that there may be some issues. Gold has been struggling. The gold price has been struggling as nominal yields on things like the 10-year have been rising. So what do you do in the short term? I'm not 100% sure. And this matters a lot for those who are, excuse me, in this audience, probably, the CSE is more the junior end of the spectrum. And so we're looking at explorers, not Newmont. We're looking for explorers of gold and copper, not Newmont and Freeport. Newmont and Freeport matter because the macro picture is always the starting point for making an investment decision. That even if the details of that decision is concern a small issuer. So what am I thinking on the short term? Well, what I think is that short-term predictions are always very difficult, but that doesn't mean that they aren't important. In fact, they're quite important. It's always better to enter on an interim dip than on a peak. And in general, investing in junior mining companies is a risky thing. So you always want to manage that risk by selling some into strength and buying more during weakness. So big picture wise, or short term wise, sorry, I keep saying big picture, so it came out, but what I'm actually talking about here is short term wise, precious metals are usually strong through to about now. And then they are often flat to down. March for quite a few months here. April, May, June, July are not great months for precious metals on a seasonal basis. Now we're in a bit of a weird time frame in general, exiting this COVID crisis. So these things may be compressed. I think that instead of things being strong, let me just go back here, as strong as usual in February, we may have the February or the March weakness actually started already partway through February. Fair enough. Like I say, things are pretty weird as we exit COVID. But what I think is that for a few months here, we're likely going to continue to see some weakness in gold and silver. My color coding here is that green are the things that I think are most likely to happen. Yellow are less likely, but still, in the ballpark for sure. And red is the least likely. And you can see that I think base metals and green energy metals and the industrial precious metals, so the PGEs, for instance, and silver to some extent, because 50% of silver is industrial, they're probably going to buck the trend and run right through from here going forward, ignoring seasonal patterns. For gold, I do think that we're probably in a bit of a holding pattern, which means that we are going to follow the seasonal pattern and maybe slide a bit for the next few months, which would set us up really well for a strong run once we get a better picture that inflation is really established and therefore interest focus shifts from these nominal yields rising back to, oh, right, real yields are what matter and they are in the basement. And so gold is a hedge against that. So I think for the next 6 months, maybe it's the base metals and the industrial precious metals that really get the attention. And so junior mining investors might focus more on those. But the flip side of that is that when they are running, the gold stocks will be in that interim dip, which is when you want to be buying them ahead of when they go, which is perhaps a little bit later in the year. That said, there's always all kinds of seasonal pressures, seasonal exploration pressures that can push junior stocks around significantly. For example, if they work in northern parts of the world and can only explore in the summer, then that can be a more dominant force for a junior explorer than these macro trends that I'm talking about. What I'm doing right now is I have been for the last little while selling enough of my gold stocks that I'm comfortable, that I know I have enough cash to cover my tax bill, that I can make my RSP contributions, and that I'm not going to stress if if my prediction of a gold slide for the next few months does just take hold, and so that I can be ready to deploy into that slide, because I do really think we are going to have a fantastic end of summer and fall. And in general, I really think that raising some cash, usually when I do that and I look back on it, I appreciate it. whether I was right about pending weakness or not. It's often a good motivation. Motivation to sell often works well because overall, the junior mining space is a dynamic one. I encounter new opportunities amongst junior mining companies all the time that I'm excited to invest in. So if I take some money off the table in stocks and have it available to deploy into new opportunities, I'm usually excited that that happened. So there you go. That's my sort of overview of what I think is going on in the mining space these days. Hopefully that was useful, interesting, helpful in some way or another. If anybody has any questions for me, I'm pretty easy to find. My website is resourcemaven.ca, and my contact information is readily available. And I am also sure that the lovely team at the CSE would also send you my way if you have anything that you'd like to ask. And with that, I'll just say thanks very much for your time and attention.
Thank you so much, Gwen, not only for your time, your insights, but more importantly, your friendship and your support. With that, we will continue this PreDAC train on to the next station. Thank you.